Hey guys, welcome back to Click Capital, your go-to channel for the latest daily market analysis and charts. And it looks like we got that down day today, as I have been positioned for. If you've been watching the channel and you knew I came in today positioned 60% net short. And apart from a few defensive names like in healthcare and utilities and consumer defensive space, there was a lot of red out there, especially in the software, few mega cap tech, and what really brought down the market today was the financials, and the most vulnerable regional bank, First Republic Bank, fell almost 50% today after reporting earnings yesterday. And what really spooked the market is they said they lost 40% of their deposits in the first quarter, and that was even with a $30 billion infusion from the top 11 banks in the country. If it weren't for that infusion, they would have lost $100 billion in deposits. So this has rattled the market, and this was a stock that was trading in the 140s just 2 months ago, and here we are today under $10 at $8 a share. So I suspect that something's going to have to be done with this stock in the next couple of days or week or so with the rescue deal, as it potentially looks to be going the way of Silicon Valley Bank. And with that move, we saw the regional banking ETF find new lows today as well, down 4.2% on volume. Although we are getting a little bit of a bounce here after hours, as we've just had Microsoft and Google report some good numbers, and we're seeing a pop in them, which I'll get to in a bit later. But with that move down in First Republic and the other banks, it's brought the 2-year yield down as well, as we've been seeing a lot of correlation in the price action between the banks and the government bond yields ever since news of Silicon Valley broke back here. So the bond market's really looking towards the banking situation as a big short-term driver on the Fed's decision. So we saw Fed fund futures come off a little bit today on volume, as the market prices in a little bit of a higher chance that we're going to get a pause next Wednesday. However, there's still a 70% chance that we do get the hike on Wednesday. And as you've been hearing me talk about these last couple of days, the volatility risk premium got it right, as it's been climbing and indicating to us that volatility may have made a bottom. And we saw a pretty good move up today, right up the front on the VIX 9-day, actually shot up to 21, and the VIX almost got to 20 as well. And now the front end of the volatility curve is in backwardation with the 9-day above the VIX. However, they're both below the VIX 3-month and 6-month, so things haven't gotten too crazy just yet. However, we'll come back to the charts. Let's keep looking at some data. So the housing market is surprisingly showing some signs of strength. We got that Case-Shiller home price come in today, and we actually saw month-over-month growth of 0.2% versus the consensus of minus 0.7%, and year over year was 0.4 over the consensus of flat. We did see consumer confidence come in a bit weaker than expected, but the biggest surprise was on new home sales. Month over month, that was up 9.6% versus 1.1 that we expected. So it looks like the price action in the home builder ETF was forecasting this correctly. And again, it's just more mixed signals for the economy, like we saw with the manufacturing come off yesterday. And retail sales have been soft, but we still have a tight labor market, and home sales looks to be growing as well. And not sure what's going on with the fear and greed index, but that hasn't been updated since April 21, so that appears to be stuck, as I would have thought that would have fallen today down to at least low neutral or into fear territory. So that appears to be an error on their website that they haven't updated yet. Dark pools look to have been correct and pulling back their buying over the last week or two. Same with corporate insiders as well, as they hadn't shown any interest in this market over the last couple of weeks either. And even though we don't have the latest fear and greed index reading, we can see there is a bit more fear out there today, because in a change of trend, we've actually saw 51% puts today. Over the last couple of weeks, we've normally been seeing between 52 and 55% calls, and it was a little busier today as well, 36.6 million contracts trading hands. And with First Republic and the other banks tumbling today, the Fed fund futures market priced in a lower probability that we'll get a hike on Wednesday, but that's still 75%, but down from 88% yesterday. And today also only now 11% chance we get another hike in the June meeting. So the bond market's saying, well, if this banking crisis is not over, it's kind of reignited with this price action in First Republic, then maybe the Fed will go a little bit easier on the rate hikes over the next couple of months. And out of all the debt ceiling showdowns we've had over the past decade or so, this one right now, the market's pricing in the highest risk that they don't raise the debt limit. And we can see that with the cost to protect US government default. The 6-month credit default swaps have shot up to the highest level ever. And that's basically insurance that the US government won't pay its debt. So there's some big money out there that is hedging against this tail risk, or maybe some think that it might actually happen, which I can imagine would cause chaos in financial markets and significantly damage the US credit rating and reputation as well, which can't be a good thing. However, the current estimates are that the US will run out of money sometime in late July, early August, and will have to have raised its debt ceiling by then to keep paying its bills. And I would say a good part of that rising cost to insure against the US government debt default is just the size of the amount of federal debt the US government now has at $31.5 trillion. That's up from $6.6 trillion 20 years ago. And with the higher cost to service that debt and less foreign nations interested in buying that debt and trading in US dollars, it could be creating a bit of a storm here that we're seeing reflected in the cost of insurance. And just to put that in perspective, we're now at around 130% of United States federal debt versus the GDP, and that was down in the 50s in the early 2000s. And that's the problem with modern day politics, because politicians have no problem spending money in the short term to win votes, but in the long term we will have to pay for that, especially younger people. However, most of those politicians will be long gone, so instinctively it looks like they don't really care. And that's what could be causing a bit more of a showdown with the debt ceiling this time, because a lot of people are recognizing that this can't keep getting more out of control with the rising cost of servicing that debt. And unfortunately, since the US government did spend between 3 and 4 trillion on the wars in Iraq and Afghanistan over the last 20 years, it looks like the chickens have come home to roost, and that will have to be paid for somehow, some way. And in a sign of deteriorating market breadth, we can see the amount of days where the amount of stocks that make new lows exceed 100 had been growing, especially for the Nasdaq. And it's normally the opposite of what you want to see in a bull market. In a bull market, you want to see stocks making new highs growing, not the opposite. And Apple has just become the biggest weighted stock of the S&P 500 ever in history, currently at about 7.1%. And don't forget, throughout history, typically when stocks become the biggest, they don't stay there. They actually have really poor performance of stocks after they become the biggest stocks. And we saw IBM have the lead for about 15 years, same with GE, and Apple looks to be coming up to that 15-year mark as well. So as hard as it is to imagine, I would not be surprised if Apple is no longer the biggest stock in a couple of years or so. And don't forget, we have recently been seeing Apple insiders sell into this rally over the last couple of weeks, including CEO Tim Cook as well. And Alphabet just reported better numbers than expected and authorized a $70 billion share buyback on top of cutting costs. So it looks like they're fighting back on the bit of negativity been surrounding the stock of late. And we can see in after hours, as I currently speak, the stock is up almost 4%. So the market seems to like it. However, whenever companies announce a new share buyback program, you will see algorithmic trading driving up the price. Microsoft as well just reported, and they came in better than expected as cloud growth hasn't slowed as much as feared. And the market's responding to that really well in the after sessions as well, up 5% here as I speak. Okay, let's run through all the major markets, then we'll go back to the main indices at the end for our final outlook. Okay, so there was a bit of negative breadth out there today. We can see that in the Canada TSX was down. However, the FTSE and other European indices like the DAX closed early, so they haven't priced in that yet. And down in Asia Pacific, the Nikkei, this is all yesterday's data we're looking at, and the Aussie 200 and the China as well. We've already talked about volatility. However, it does look to have put in a bottom down here as we got really low down in the 16s and almost hit 20 today as I've been forecasting. Bond market volatility perked up today as well. We can see that with the MOVE index moving up to 137 and a few more puts being bought here. We can see the put call ratio at 0.95. And look at that dive in market breadth. The amount of stocks above their 20-day moving average at 43%. That's really rolled over. And we can see that also in the 50-day and 200-day as well. In addition to stocks making new highs is really low, 30 on the NYSE, and only 27 stocks made new highs on the Nasdaq today. Some of the spreads we monitor got hit hard today. Growth sectors versus defensive down 1.4%, and high beta versus low volatility stocks came off really hard today, 3.1%. And that's got to do with the defensive rotation we've been seeing. So a lot of big money's moving into these low volatility, safe balance sheet quality stocks in the defensive sectors, and that's something we've been seeing for the last couple of months now, ever since we peaked on February 2 in this spread. And the Nasdaq versus SP 500 stocks as well continues down underneath its 50 bar. And a little bit of a jump up here in the yield curve today. Here's a 10-year and the 2-year. And this is the 30-year and the 2-year as well. So when these yield curve spreads move back above zero, that's typically when the recession is just around the corner. And we can see high yield bonds versus treasury bonds of a similar duration just lost its 50 today as well. And inflation expectations as measured by the inflation protected treasuries versus normal treasuries moved down today below its 50 as well. And the 2-year moving down below 4% today, coming up to a big resistance zone here we saw after the initial shock of the banking crisis back in mid-March, and the 10-year as well back down to its big 340 level support zone, which I think should hold because I think they will get on top of this First Republic situation. They're probably working on a rescue deal right now, which should send the markets back up along with rates. And since inflation isn't going anywhere anytime soon, the Fed should still hike on Wednesday. But we can see in the Fed fund futures that the market did just price in what's happening there in First Republic a little bit and pulled back its probabilities. And with those lower rates and a bit of fear out there, we saw the TLT climb today 1.4% on above average volume. Investment grade debt still looks good here, well above its 50, and high yield still holding above its 50 but came off a little bit today. So not a whole lot of fear out there in the bond market. And contrasting against the norm with those lower rates, we actually saw the dollar hold its support here today and pop up a bit above 101.50 in what might have been a bit of flight to safety. And even though we had a higher dollar, which is normally negative for Bitcoin, with that fear in the banking system kind of popped up again here today. And remember, it was back in March 9 and March 10 when Silicon Valley Bank went under that Bitcoin rallied off that news. So that looks to kind of be resuming again here today on that First Republic move. And with that dollar higher, we saw commodities pulled back a little here today. There was a little dip by below the 50 bar on the commodity index. Gold is still holding here at $2,000 an ounce. And crude traded a little lower here today, getting down to $76.50 a barrel. And over to stock sectors, see a red out there except for gold miners, the only green sector up there today. The defensives performed a bit better with utilities basically flat, along with staples. Healthcare came off a little bit. We saw transports come off a lot, 4.2%, and that was after UPS reported earnings, which I'll get to in a bit. There's the regional banking ETF again today. We're going to be looking for some support here around 40 over the next couple of days. We've still got the big banks financial sector above its 50, and energy stocks holding up a little better versus crude. Retail came off hard today, down 3.2%, and semis as well, down 3.1% on big volume here. BlackRock came off another 2% and looks to be testing its 50 today. JP Morgan has pulled back, and Tesla only came off 1.1% today. So that looks to have held a little bit here today, and Nvidia was down almost 3% as well, just above its 50. It's getting a little pop here in the after hours from Microsoft and Google earnings. However, a close below its 50 and this box I've had in here for a few weeks could induce more significant selling in the weeks ahead. We got Apple reporting earnings in 9 days, and that only came off a little bit today, less than 1%. Microsoft sold off 2.2% today into earnings, but here we are after hours as I speak, up 5.3%. As their numbers came in a bit better than expected, they reported earnings per share $2.45 versus $2.23 estimate, and revenue was a little bit better than expected as well. Amazon was off 3.4% today, and they're reporting earnings on Thursday, so we'll be watching that one as well. Google, similar to Microsoft, was off 2% today, but rallying up a little bit as well after hours here, 3%. And we got Meta reporting tomorrow. AMD still isn't reporting for a week, but has been trading really weakly lately compared to the rest, down 4.3% today. Netflix as well looks to be going below its 52. Meme stocks were mostly red today, as you'd expect. And General Motors reported as well, and even though they came in with a bit better than expected earnings, but the market didn't seem to like it, selling off 4% today, as they might be expecting a few more price cutting and discounts out there like Tesla have been doing as well. And like we saw with consumer staples stock Procter & Gamble last week rally up on some good numbers, we saw the same again today with Pepsi. But with weaker retail sales, we're seeing companies that move things around like UPS give softer guidance, and the market did not like that at all, down 10% on big volume here today. Chipotle came in a lot better than expected with earnings beating, and we're up here 7.6% after hours. And Enphase Energy just reported as well, and even though they came in with better numbers than expected at $137 a share, they gave weaker guidance for the current quarter, and the market didn't like that at all, selling off 16% in after hours. Deutsche Bank's back under its 50, and we'll be watching this one to see if it might go the way of Credit Suisse. And just a quick look at First Republic, trading pretty much flat in after hours here, so we'll be looking for a rescue deal on this in the next couple of days and see if the banking sector and market as a whole can get a bit of a pop off that. Contrasting that is PacWest, which looks to have just reported, and we're rallying up here almost 15% in after hours. Western Alliance is still holding above its 50 with a nice little pop here after hours as well. And Bank of America just lost its 50. However, we've got Citigroup and Wells and Schwab didn't have a good day, down almost 4% as it hasn't closed above its 50 either. Okay, let's head over to the main indices for our final outlook. Okay, so we got a pretty good down move here today as I've been forecasting. We finished right on our lows, pretty weak with a bit of volume. And we've still got about 170 point gap between the global net liquidity model and the S&P 500. We are getting a little pop here in after hours on the SP, up 0.47%. We'll see if that can hold tomorrow. And the Nasdaq's actually up 1% in after hours as well with those Microsoft and Google earnings. So the real test tomorrow will be if we gap up, which looks like we will gap up, whether that gap up gets sold or we get a gap and go. And so it's just kind of whether those positive beats from Microsoft and Google outweighs what's going on in the banking sector with First Republic. If a Fed along with the big banks announce a rescue deal for First Republic, which I expect, the markets should gap up really well off the back of that news. Whether that holds or not is another story. However, with volatility popping up pretty good and a little backwardation up the front, this sell-off might not be done just yet. Especially with breadth diving pretty good here today. And that big obvious move into low volatility stocks accelerating here as well. So with all that, I've kept my positioning at 60% net short, and I'll be paying close attention to the price action tomorrow when we gap up to see whether that can hold or it just falls away. And I'll also be paying close attention to the price action in First Republic Bank and seeing whether they're going to get a rescue deal and what that does to the price action of the banking sector as a whole. So we're almost halfway through this earnings season. So far, so good. Around 70% of companies are beating EPS, even though that's a lower bar. That's been set. The earnings picture doesn't look too bad at this stage. Okay, that's all I got for you today. Thanks very much for tuning in, and I hope to see you again tomorrow afternoon in what looks like to be a continuing interesting week with mega cap tech earnings, and the banking crisis look to potentially be reigniting as well, giving us a bit of a spark here in volatility. All right, guys, see you then.